Throughout history, the value of money has constantly shifted, almost always downward. If you held a $100 bill in 1900, it had the purchasing power of over $3,000 today. This continuous loss of purchasing power is what we call inflation. Most people understand that inflation makes goods and services more expensive over time. But few understand the underlying mechanics of how and why monetary devaluation happens. Today, we're going to look at the history of inflation to see how governments and central banks shape the value of our currency. To understand inflation, we have to travel back to ancient Rome. The Roman Empire did not have paper money or central banks, but they faced massive financial pressures. To pay for wars and public works, emperors began a practice known as currency debasement. They took silver coins, melted them down, and mixed in cheaper metals like copper. While the face value of the coin remained the same, the actual precious metal content plummeted. Over time, merchants realized the coins were worth less and raised their prices accordingly. This ancient debasement is the earliest form of systemic monetary inflation. Centuries later, the introduction of paper money made devaluation even easier. In the 20th century, the gold standard acted as a constraint on the supply of money. Because paper bills were backed by physical gold, governments could not easily print money at will. But during times of crisis, like wars and depressions, these constraints were often abandoned. In 1971, the United States officially severed the dollar's last link to gold. This birthed the modern era of pure fiat currency, where money has value only because the government says so. Without the gold standard, the supply of money could expand rapidly. When central banks increase the money supply faster than the economy grows, inflation is the inevitable result. More dollars chasing the same amount of goods naturally drives prices higher. Central banks target a low and stable rate of inflation, usually around 2% per year. While 2% seems small, it compounds over time, cutting the value of your savings in half every 36 years. This gradual erosion acts as a hidden tax on holding cash. Inflation also redistributes wealth from savers to borrowers. When the value of money declines, the real value of debt decreases as well. For governments with trillions of dollars in debt, moderate inflation makes that debt easier to pay back. But for ordinary citizens, wages often lag behind rising prices, leading to a drop in living standards. In extreme cases, inflation can spiral out of control into hyperinflation. This occurred in Weimar Germany in the 1920s and Zimbabwe in the 2000s. In these scenarios, the currency becomes virtually worthless and people resort to barter. Today, central banks use interest rates to control inflation. By raising rates, they make borrowing more expensive, which slows economic activity and tempers price rises. But high rates also risk causing a recession and rising unemployment. Balancing inflation control and economic growth is the ultimate challenge of modern monetary policy. For savers, protecting wealth requires investing in assets that appreciate faster than inflation. Historically, real estate, stocks, and commodities like gold have served as inflation hedges. These tangible assets represent real-world value that cannot be printed away. Understanding the history of inflation shows that holding cash is a guaranteed way to lose purchasing power. Wealth preservation requires active management and understanding the nature of fiat currency. As monetary policy evolves, the battle against devaluation remains a constant theme. The core rules of monetary history have not changed. Supply and demand govern all value. Keep your assets diversified and focus on long-term value to protect your financial future. In the next decade, technology and global shifts will continue to test monetary systems. Stay informed and adapt your financial strategy to stay ahead of currency erosion. Every monetary system in history has eventually faced the challenge of inflation. Those who understand this history are better equipped to build resilient portfolios. Focus on acquiring productive assets that maintain their value over time. Protect your hard-earned savings by